Hey everyone, welcome to another episode of Wise Up, a finance podcast made by and for Gens Y and Z to help you be better with money. Now, I know we've been off for a week. Last week was Rosh Hashanah, as well as the unexpected visitor that we call Hurricane Ian. Now, thank God, here in Jacksonville, didn't get much of it, but being cognizant of the impact that it's had on Florida at large, having family and friends in the Tampa, Sarasota area and Fort Myers, I'm very well aware of the impact that it has had. So, to anyone who was impacted by Hurricane Ian, my thoughts are with you. My serious condolences to anyone who has passed, who knows someone who has passed. I think the current casualty mark is at 64. Total damages, financially standing around $100 billion. So, I count my blessings that it was not as bad as it could have been here in Northeast Florida, that it changed directions. But I'm fully aware that it did impact many other people. So I will take, I guess, the pros and the cons and try to view the silver lining in things. But we are back. It's good to be back. We will be off on Wednesday due to the Jewish holiday of Yom Kippur. So it'll be a slightly impacted week, but we'll work with it. We'll see how it goes. I am glad that all of you are here. Again, I hope that you're having a good start to your day. As always, before we get started, if you're new here, do me a favor, follow the channel, like it, share it with friends, subscribe to it, leave us a review. If you are a continuing listener, I appreciate your support. It really does mean the world to me. It's been really fun doing this podcast last month and a half or so, though admittedly we were off last week unintentionally. I do appreciate all of it. And with that, let me just get into a quick sneak peek into what we're going to be talking about today. First and foremost, the absolutely atrocious state of financial advertising. There's some news regarding one of America's most beloved, almost royal families. On top of that, there's now news coming out from across the pond that is going to impact us one way or another. And really how I think this all can be boiled down is a phrase that I've used quite a bit in prior podcasts. History tends to repeat itself. Again, some say that it rhymes. I believe it repeats, and I'll explain what I mean towards the latter half of this episode. First things first, let's talk about Kim Kardashian, shall we? Now, I never really thought that running a finance podcast, I would find myself talking about Kim Kardashian. It really just didn't pop up for me. I didn't think I'd get to that point. But here we are. This is the world we live in today. The reason we're talking about Kim Kardashian is because she is going to have to pay $1.26 million to the SEC. Why, I hear you ask? Well, because back in June of 2021, Mrs. Kardashian decided that it would be an appropriate time for her to promote a cryptocurrency. Now, specifically, I think it was Ethereum Max. For those of you who have never heard of Ethereum Max, I don't blame you. Most cryptocurrencies have no value. This one was no different. I say this respectfully. Now, back in June of 2021, Kim was paid $250,000 to promote Ethereum Max. What she did essentially is that she posted about it on her Instagram to all of her followers, and then they did the thing. I say this lovingly, you should not ever be buying any asset, really, that is trading for, and this is direct quote from that day, 0.000023 of a cent. I may have missed a zero. In other words, this thing was worth less than a penny, not even a tenth of a penny, not a hundredth of a penny. This thing was worth nothing. And yet she was paid $250,000 to promote it on her Instagram story to her following. What is most shocking to me is that now, in the, God, how long has it been? 15 months or so, since June of 2021, we can now say that Ethereum max tokens have fallen to a mathematical approximation of zero. Looking at what it was trading for back in June of 2021, I thought that was a mathematical approximation of zero. Like normally in finance, we like seeing zeros after the real numbers and usually with commas in between. If you're seeing zeros after a decimal point, with the number directly preceding the decimal point being a zero and no other number before that, you've got a problem. I don't know why anyone bought this, but this goes back to the point of I've never been big on the whole influencer thing. I can't really say I've ever seen a TikTok, an Instagram, a Snapchat, or even a traditional TV-based ad with a celebrity and gone, oh, dude, I need to buy that. Yeah, can't really say that's ever been me. I can call all my family and friends just to double check, but I don't think that I've ever been the guy who looked at a celebrity and went, yes, they're a brilliant person to be taking advice from on what type of cryptocurrencies to buy. Or again, even more mundane things like a vacuum cleaner. Like, why do I care what some A-list celebrity does to clean their homes? Are they somehow now best equipped to tell me how to clean my home? What is this nonsense? I don't know. I must have skipped that phase where celebrities became gurus for things. But unfortunately, people did listen to Kim Kardashian. This is still something that it disappoints me. It really does. And because of that, because of the fact that she didn't disclose to her followers that she was getting paid $250,000, $250,000 for promoting something that was worth essentially nothing. That in of itself is a scam. Aside from the entire story, if you are promoting something that again was worth $0.00000023, you got to be able to look up and go, maybe I shouldn't be promoting this to people. Like, I understand that Kim Kardashian isn't a financial advisor, might not have a bachelor's, a master's, a PhD in finance, but I feel like there's some basic common sense in looking at something like this and going, something doesn't feel right. I don't know what it is, but there's something here that does not feel right. I might be asking too much, I accept that, but whatever it is. So on that day that she posted about it, $22 million worth of Ethereum Max tokens were traded. Now, again, the major issues here are, A, that she promoted it without disclosing the fact that she was being paid for it. 2, the fact that these Ethereum Max tokens were essentially unlicensed securities. I talked about this with Brian Nibley when he came on the show. Most cryptocurrencies today can technically be qualified under the Howey test of a unlicensed security that they are traded with the expectation of earning profit off of someone else's labor. That's a very boiled down explanation of it. So she committed fraud. So because of that, the first thing she has to do, so the $1.26 million settlement, what does that actually mean? The first part is a $250,000 disgorgement. Disgorgement from legal terms just means that you have to give back all the funds that you wrongfully got. So the $250,000 that she was paid gives back. On top of the $250,000, she's also giving back $10,400 in interest, hence the $260,000 part. The $1 million is a civil penalty the SEC is also imposing on her. And therein we get to the $1.26 million fine. The moral of the story here. I'm sad that I still have to explain this in 2022. Don't take financial advice from celebrities. That may be groundbreaking. I don't think it is, but it might be, given that people still listen to celebrities, especially on financial issues. I mean, that was a running joke, I think, after the Crypto.com Fortune Favors the Bold ad. Fortune Favors the Brave? The Bold? I don't remember anymore. With Matt Damon, where he was, I believe, orbiting Mars, looking back on history. And it was at that point where ever since then, prices of all cryptocurrencies have gone off a cliff. And then more recently, I think they're restarting those ads, except now with Joel Embiid, the NBA star. I really don't know why these people are doing so much in a space that even practicing financial experts don't fully comprehend. I mean, and celebrities have been getting in on this for God knows how long. Well, didn't Justin Bieber have NFT collection or something? I mean, it feels like at this point, every celebrity has gotten into cryptocurrency, Web3, NFTs, the entire space at some point or another. And at this point, I really just, very simply, friends, if you'd like to be better with money, don't take financial advice from celebrities, especially those whose initial claim to fame was a sex tape. Again, I may be wrong for that, but I don't think so. Anyway, shifting away from Mrs. Kardashian, we continue looking at the average American's spending habits. And I've discussed this quite a bit. That's kind of the point of this show. And I've talked about how I believe that people should still have an escape from their day-to-day life. In the sense that if you once a week, whatever it is, go out, to a diner, a bar, an event of some kind, just to get a reprieve from your day-to-day life, in order to recharge, so to speak, socially, mentally, emotionally, fine. Again, I still think you should do so within your own means. But if you, gain the joy, the relaxation that you need once a week by catching a game at a local bar, fine. I don't blame you. However, there are some things that do concern me. About 1/3 of Americans anticipate, not even the ones that are fully going to, but 1/3 of Americans anticipate going into debt spending on sports. That disappoints me on a number of fronts. I will speak as an avid, sports person. If we turned the camera around and looked around my entire office, you'd see sports memorabilia posted around the entire place. I love sports. I really do. I grew up playing them. I still follow them, watch them. I hold back on calling myself a fan because I don't think I'm a fanatic of anything. I don't really yell at my TV. Again, I'm a weird person. I just don't do it. But 1/3 of Americans are anticipating going into debt rooting for their favorite sports teams. And that number, generally speaking, is distributed the way you might think. Only 11% of boomers expect to, whereas 42% of both Gen Zs and millennials expect to. Guys, I get it. I know that we've been locked in our houses for a couple of years, but COVID's basically over. Even Biden announced that a couple of weeks ago. You don't need to revenge spend. I promise you, you really don't. And the funny thing is that this isn't just talking about sports gambling, because only 8% of Americans plan to engage in any type of sports gambling in particular. So it's not that these people are anticipating going into debt because of their gambling issues. No, they just mean going to a game or buying merch. Guys, at this point, I almost feel like I've got a, not a 180, but 45-degree turn here. Again, I know I promoted getting a reprieve from your day-to-day life, but I still said that you should do so responsibly. I said, sure, maybe at the expense of investing, insert arbitrary amount. I believe the number was always 10%. I said at the expense of that, not at the expense of not being in debt. I don't think you should go into debt to watch your favorite sports team. Full disclosure, I don't think that is prudent for anyone to be doing. It's really not, especially with financial conditions as they are. Taking on more debt, taking on any debt is not smart to do. Again, I've talked about this almost ad nauseum on the show as well, the cost of carrying debt. Not only financially, but also socially. The impact that it has on relationships, platonic and romantic. you don't want to be carrying debt. And, I'm quite thankful for this, little piece of research, because this was actually only published a few days ago. So I guess, thankfully, while I was avoiding a hurricane, and celebrating the Jewish New Year, surveys were sent out to a few thousand people about their spending habits, and we got this back. So this was published yesterday. It's great. Now I have things to talk about. This should not be this high. And again, I understand why the numbers are skewed as much as they are from, let's say, younger generations. Although millennials, again, the oldest millennials are in their early 40s. So I don't want to say it's the darn young people, because it's also the middle-aged people, given the statistics. So again, it makes sense that the boomers are the ones who are less likely to go into debt, because generally speaking, they have spent decades in the workforce, have saved up for retirement, so have more liquid assets, hopefully, to spend on things. But I don't know what the millennials are doing, respectfully, because those dudes are 26 to 42, if I'm getting my bracket right for the millennials. Should also be people who are in the workforce, have been in the workforce for a solid decade or so, if not two. Guys, why are you going into debt watching sports? Not even betting on sports, but like watching sports. Just do better. Watch your habits. If you know that you want to spend on your favorite sports team, cut back elsewhere. Again, don't go into debt. I will not promote that you go into debt for frivolous means. And I've also discussed in previous episodes the point of going into debt for financial purposes, meaning acquiring a loan in order to buy property. That is a different conversation. Spending money to watch a game or to buy an overpriced jersey, t-shirt, or hat, very different. That is bad debt. You do not want that. Don't promote that. If you plan on spending, cut back elsewhere. Very basic budgeting advice. Just don't do it. Okay? Now I'm going to shift rather radically, let's call it. And we're going to talk about what's going on in the UK right now. Because this is something that I was very loosely following last week, given everything that was occurring locally. The UK government last week had announced, primarily from their new Prime Minister Liz Truss, they planned a tax cut on the highest 45% tax bracket. They announced it, and everyone got very upset. How dare you, how dare you, how dare you, how dare you. Repeat that enough times, and then as of today, officially, they are scrapping that plan. Moral of the story, complain loud enough and long enough, people will listen to you. Thank you for your time. I'll be here all week. In honesty, though, it was a rather interesting couple of weeks for the United Kingdom, avoiding the loss of the Queen, which shook the entire country. The United Kingdom, I believe a week and a half ago, officially announced, the Bank of England officially announced that the UK was going into a recession, or that it was in a recession. And this, for me, as a financial analyst, as a commentator, really was just almost an inevitability. I remember seeing the news and going, okay, yeah, that was expected. We all saw this coming. Speaking to people from the region, having inflation in double digits and expected to continue climbing into the 15, 18, 21% range isn't sustainable. The concept of having a freezing cold winter with electricity companies going out of business, with people shutting off power because they can't afford to run it, people tearing out stoves and other appliances from their homes because they can't afford to have them running. At that point, yeah, I think everyone saw a recession coming. So the United Kingdom was placed in a very precarious position. Again, because this is roughly the same time, perhaps only directly before the Queen's death, that Boris Johnson, the former Prime Minister of the United Kingdom, had abruptly resigned after a no-confidence vote, if I remember correctly. So there's been a month or so of constant turmoil in the region. And given the harsh economic turmoil, The plan to cut taxes for the high earners that made above 150,000 British pounds in a year, the argument for was that, again, that would stimulate the economy, given that these earners pay the most in taxes, contribute the most to the economy, whatever it might be. The argument to the contrary was that cutting taxes in a time when the government needed as much money as it could to pay for different social programs, different bailouts, when the economy was as poor as it was imprudent, as well as being unfair to lower income brackets. It was a rather large debate that was occurring for the past week or two. So today, rather abruptly, it was just quietly shuttered. And the new Prime Minister, Liz Truss, kind of admitted, yeah, I could have executed this better. That would be an understatement of, I can't even say the year. God, this freaking hell. Might be the understatement of the week. It was not well implemented or announced. And as an American, it's kind of astounding to actually look at their tax brackets, because now I'm learning things about the United Kingdom. I didn't know that they had a 45% income tax rate on earners earning above, depending on the exchange rate, let's just say around $160-something thousand a year. That is remarkably above what we have here in the United States. So it was astonishing to me. So they planned on cutting it, just kind of removing that 45% tax bracket, essentially, I guess, in favor of the next highest rate. However, it's kind of weird because they still seem to want to do it. The plan is the correct one. But, in issuing a statement there, Treasury Chief Kwasi Kwarteng, I hope I pronounced that correctly, forgive me if I'm not, basically said, we get it, we have listened. It is clear that the abolition of the 45% tax rate has become a distraction from our overriding mission to tackle the challenges facing our country. Essentially, the joke I made previously, if you complain long enough, loud enough, you will get your way. I guess that's a foundational premise of governments that aren't tyrannical, but, give or take. But it's a rather stunning turn from the last 10 days or so. Because, again, in the span of a week and a half, it went from, hey, this is what we have to do, stimulate the economy, we'll save the United Kingdom, it's what we'll do to correct everything, and then the British pound starts going to absolute ever-loving hell. The markets react poorly. Again, the constituents in the country react poorly. There are, I believe, over 60% of British residents start, I don't want to say demanding, but proclaiming that Prime Minister Truss should resign. It's been a 10 days for the United Kingdom. And overall, they're in a very poor position. Because, again, all the things that I laid out directly before this tax rate issue, the whole point of the Bank of England already announcing that the country was facing a recession, the inflation that is in the double digits, potentially freezing winter that has the capacity, depending on how strong the weather is, to end up in casualties and fatalities. All of those underlying things still exist. So even if the current plan of scrapping the tax rate has been replaced by something, or at least is on the back burner, they still have to figure out how to navigate the next few months, and that will be very difficult. That'll be very difficult for a number of fronts. See, even here in the United States, we're talking about inflation. We've been talking about inflation for the better part of a year. And the entire conversation is about, when can it get back to 2%? 2%, as I've mentioned in prior episodes, is the targeted inflation rate for the federal government. And the Federal Reserve targets 2% inflation as a healthy range. It's just the economy is still growing, it's not stagnant. But anything too high, it's a bad thing. Deflationary cycle too low means the economy is not growing at all. Again, I'm simplifying a lot of complicated terms, but essentially they aim for 2%. Dr. Rob Arnett did a quick study, let's call it, of several dozen economies that had seen inflation rates surpass 10% and concluded that it took between 6 and 35, not months, but years to return to 2% inflation. Meaning, and I say this, I guess, kind of happily for the United States, given that our official CPI only peaked at 9.1%. But for those in Britain who saw their CPI, or their version thereof, surpass 10%, that means that the odds of inflation going back to 2% within your generation is questionable. It might even be minimal. So whenever we're talking about how we'll see inflation return in a year, 2 years, 3 years, probably not. Hell, even the United States, probably not. I mean, it might legitimately take a number of years, even here in the US, because 9.1% is still remarkably close to 10%. So again, I'm still not expecting a 6 to 35 year range. Hopefully it's remarkably shorter, but people who are aiming to see inflation at 2% within the next year, I think, are being overly optimistic on a large series of fronts. And this goes, again, back to the topic of history of repeating, because this is a study of history to look at the world and say, hey, in all the times that we've seen inflation go above 10%, how long did it take to get back to 2%? You look at the math and you go, oh, well, not soon. Actually, it took a while. It's not a great thing. It's really not. So when people kind of discuss where things are going, how things are doing, or we occasionally revisit the now infamous line of inflation being transitory, and we all have a good laugh about it, understand that given the historical data, we're going to be facing an issue for a number of years. We will not be past this anytime soon. And to kind of hammer on the point that I've been beating in every time I've discussed inflation, this is directly a response to all of the nonsense fiscal and monetary policies that we've seen in the last 2.5 years. Again, in the US, over 40% of the money supply today has been created since January of 2020. We've just been printing money and expecting there to not be any repercussions. Government came out like, we're going to solve inflation by printing more money. Inflation walked in like, am I a joke to you? Did we all just skip the most basic lessons of high school economics? Like, I'm an issue, guys. No, you're transitory. And then here we are, a year later. And we are realizing that inflation is not transitory, and their friends in the United Kingdom are realizing this even more so. And this is going to get remarkably worse. But I will cover that in a few seconds. See, news broke about a week or two ago. Again, the United Kingdom has been going through it recently, that the UK was freezing new mortgages. That lenders were just saying, no, we can't, not anymore. Absolutely not. We cannot issue new mortgage-based products. We're done. We can't. Nothing else. Why? Well, my friends, because of interest rates. And the constant fluctuations in these rates, mortgage rates, the cost of insuring credit default swaps, which I will cover in a second. Major lenders just said, essentially, screw it. We're done. We give up. No mas. We can do no more. And that is a substantial problem, because if you weren't nervous about a housing market recession, you should be now. I mean, legitimately, it's causing a major issue. Again, the constant changes in rates, constant fluctuations, especially as currencies continue to fluctuate as wildly as they have. I see my prior comments about the massive fluctuation in the British pound in recent weeks. Lenders are just saying, screw it, we're done. And there are some that are going on record and just saying, listen, It's bringing us back to flashbacks to 2008. We're withdrawing mortgage products because of turmoil. There aren't any fixed rates available for new customers. It does sound a lot like 2008. And because of that, now these same lenders are saying that if the Bank of England, let's essentially just say that their version of the Federal Reserve here in America, does not raise their base rate to 5 or 6%, mortgages will be unaffordable for most people. Again, they have to screw with rates, to screw with the economy to make things affordable. It's a weird calculus that they have to do. But that's what's happening. Where the housing market is going to absolute hell. And now, again, this news broke a week or two ago. And again, here in the United States, we haven't really talked much about it. As with most issues, NIMBY, not in my backyard, not my problem, out of sight, out of mind. We are going to feel it, though, and that became even clearer over the weekend. Now, again, around Sunday, I was checking my phone, and I saw a bunch of posts backdated several days about rumblings that people were hearing coming out of major lenders. And at first, no one was sure what or where, why, or how. But then, as I went through the timeline of things, by about, seems Saturday night or so, people had started to direct the spotlight, let's call it, on Credit Suisse. And today, news broke. Credit Suisse is doing very poorly today. Now, in the pre-market, their shares tanked, I believe, 10%. And I'm going to summarize a whole host of issues, but essentially, they have major financial concerns. They don't know if they have enough capital on hand. And they're a major lender. So, related banks, like UBS, is also getting hit. And let's get back to a topic, or concept, that I very briefly opened up with, called a credit default swap. For those who do not remember the 2008 financial crisis or have not studied finance, let me give you a very quick crash course on credit default swap. A credit default swap, put simply, is a form of insurance. That is the simplest way that I can explain it to you. It's a financial derivative in which one party can offset their risk with another. Again, that's why it's called a credit default swap. So the lender buys a credit default swap from an investor, and that investor agrees to reimburse the lender if the borrower defaults. Again, we're getting into rather complex, loan origination issues and all the other fun things. Essentially, it's insurance. The credit default swap is maintained by a recurring and ongoing premium payment that is paid. So the lender who is worried about the borrower defaulting will use that credit default swap to offset risk. The simplest way that I can put it. As you can tell, this form of insurance can be quite lucrative, let's call it, if you're expecting a major housing collapse. So, credit default swaps on mortgage-backed securities, mortgage-backed obligations, were very popular between 06 to 07, 06 to 08 roughly, because some people started seeing the major flaws in the market, in the housing market, and said, hey, we think that it's going to crash, people are going to be unable to make their premiums, that they're going to default on their payments, we should buy the insurance because then we get the payout. Lovely idea. So when Credit Suisse announces that they're having major issues financially, UBS, who issues, let's call them, credit default swaps, their rates hit decade highs. You have a major problem if major borrowers, lenders, originators, issuers are having problems financially. That's not a good thing. That's really not a good thing. So now there is some rumblings, let's call it again, in the finance space, that this is essentially a Lehman Brothers moment. I mean, Credit Suisse's credit default swap spread, kind of the spread between basis points on different credit default swaps, is at 14-year highs. If you can do the quick math, 14 years ago is the great financial crisis. Yeah, we are at levels that we have not seen since then. If you're not nervous, you should be. This isn't a good thing. Like, we're already higher than it was back in 2007 or so. So before everything officially went to hell in a handbasket. Like, we're higher than things were in 11, 12 when people weren't sure how the recovery was going. We're significantly higher than things were in 2020 when the world shut down. It's not going well. So as a comparison, Lehman Brothers, the major financial institution that went belly up and took the world with it, they held $600 billion in assets when they crashed and burned and took the global economy down. Credit Suisse and Deutsche Bank, we're now kind of operating in tandem, hold $2.8 trillion in assets, roughly 4.6 times more than we did 14 years ago. According to Credit Suisse CEO, they're at a critical moment. So before market opened, again, the stock was down 10%, and yet, as of right now, according to Stock Ticker, it's up 1.66%, and the markets are all broadly up. And I'm sitting here and going, I don't get it. You have a major financial institution basically announce that we're heading for 08 Part 2. A couple weeks after the entire United Kingdom sent a giant warning sign of we're heading for 08 Part 2 when they froze mortgages. And markets are going up. And the company that announced that they need to do a financial restructuring because of major monetary concerns is up. This is one of those moments where I really consider if that degree over my shoulder that says a master's in investment analysis means absolutely nothing, because this makes no sense to me. I mean, legitimately, the fact that we're up on a day when everything should be going to hell, I don't get it. I don't. So if this is one of those moments where you're looking at me and going, hey, Gabe, so what should we be buying right now? I'm not Kim Kardashian. I don't do that. But also the correct answer is still nothing. None of this makes sense. Financially, there are no good deals right now. Nothing is on sale. Nothing is fairly priced. So whoever is sitting here going, we can get a good deal right now. No, you can't. Not in the slightest. Again, I've discussed the whole point of PE ratios and valuations on the show quite a bit. We are nowhere near even being fairly valued. Screw undervalued. We were just marginally less overvalued than we were. Everyone who's sitting there and going, dude, it's time to be buying the dip. Good luck. May the odds be ever in your favor. I will not recommend that. Especially when, again, we're getting a horrible economic news. When, I believe this was last Friday, if I remember checking my timelines correctly, employment data came out, and initial claims dropped back below $200,000, which is causing concerns of, oh no, the employment market is doing well. Oh no, that means inflation is going to stay high. Oh no, that means the Federal Reserve will have to continue hiking rates massively to get inflation under control, thus tanking the economy. Like, people are still fighting the Fed. Jay Powell, finally, is trying to be as blunt as he can with you. Stop hiring people. And this impacts me too. I'm one of those people. I've accepted it. They're trying to slow down the economy. If people keep hiring with money that they don't actually have, because again, the global debt levels are at very, very near record highs, and people keep going into debt, but also inflation keeps going up. People can't afford things. Eventually, the whole concept of a soft landing has to be erased from the dictionary, because at that point, if we just continue putting this off long enough, I mean, at that point, we just crash and burn. See, the best way to avoid a major cataclysmic event is to address the problem before it gets out of hand. You know, as with anything else, if you have an infection in a finger, you don't wait till it spreads through the entire arm to treat it. Because at that point, you might not be able to save the arm, let alone the finger. However, if you treat the infection once it's only in the finger, screw saving the finger. You might just be able to treat it with some antibiotics and be fine. Like, it's very simple, common sense. If you allow an issue to progress, especially one that I can quite accurately use as an allegory to an infection, given the global contagion effect that many of these financial issues have, you set yourself up for failure, because then you can't deal with the root issue anymore. You have to cut it all off. Like, this doesn't end well. I don't know how people still, can wake up, get on TV and go, well, Jim, the markets are doing fine today. What do you think we should be buying? Well, I think we should be buying more of Apple. I don't know why Apple announced a week or two back that they saw that their demand for the new iPhone 14 is going to be lower than expected, but fine. That is actually news. That's a real story. Apple is very openly said that demand for their iPhone 14 is not as high as they thought it would be. Nike has announced that they're sitting on more inventory than they know what to do with, and markets go up. It's weird, but also not entirely unexpected. Bear market rallies are a thing. We've been seeing them a lot recently. They will not last. I'm just mad that we have them. I would prefer if we just saw a straight line down so we could be done with this process, because I'm tired of talking about gloom, doom, recession. I'd rather we just be done so that eventually I can talk about what to invest in, where to put your money, and how the economy's on the upswing. Like, that's what I'm looking forward to. I don't particularly enjoy this. If you're watching this thinking that I enjoy talking about how everything's going to hell in a handbasket, no, not in the slightest. My job as a market analyst, though, is to check my ego at the door. So I don't talk about things that I want to talk about. I don't project my own wants, needs, morality, ideas into the world. I look at the world and say, what is it telling me? And at the moment, the world is telling me that we're screwed. And you can't have a major global economy, which the United Kingdom is, announce a recession while there is still a war going on. Several countries to the east, most recently escalated in a referendum, which will definitely escalate conflicts, which was preceded by the Nord Stream pipeline suspiciously springing a leak, which will only exacerbate the winter issues in Europe this winter. While in America, again, mortgage rates are at near record highs, above 6%, and global lenders like UBS, Credit Suisse are announcing they're having major financial difficulties, which comes off of the back of the United Kingdom announcing they were freezing mortgages, not even discussing what's going on in the rest of the world. If you're looking for fluff pieces, stories that make you feel good, this ain't the place. This also isn't the time. I'd rather not lie to you. I might be wrong. That's fine. But anyone who can get on camera, whether that's on TV, on a podcast, an interview, whatever it is, and tell you with a straight face that we've hit market bottom, that we're going to see continued economic growth for years on end, that we're all going to be fine, that inflation will be addressed swiftly, that is a level of dishonesty that I do not tolerate. So for you, the average listener, again, how does this relate to you? A, the fact that, again, history is repeating, that we saw this back in '08. Again, different financial institution because Lehman Brothers, as has been made clear, went under 14 years ago, but the same financial instruments, credit default swaps, mortgages, the entire mortgage market, these are the same things that have existed for decades. The regulations around them, the major players may have slightly shifted and altered, but it's the same thing. We should have seen this coming. I'm sure there are going to be some people who get on camera and say that they did see this coming. I will not claim that level of cognizance. Admittedly, housing market has only been on my radar the last year or so. This, in of itself, the entire debacle of what's going on globally and domestically, kind of traces back to the comments about Liz Truss and the scrapping of ideas to cut the top tax rate. People need to stop tolerating being lied to, or at minimum being misled. Let's give people the benefit of the doubt, despite the fact that I believe my last episode was actually about politicians and insider trading and massive issues around that. My goal, again, in all of this is to get people to a point where they understand how these markets work. Not just so that they themselves can invest for themselves and for their families and create hopefully generational wealth, but also so that then they can look at their politicians, market analysts, prognosticators, talking heads, listen to them and go, you're full of it. And hopefully vote for better people if you so choose. Or at least, choose where you tune in for television or podcasts. I hope you stick around here. But the overarching goal here is to get people to stop buying into nonsense, but also to know how to avoid the negative detriment of what we are staring down the barrel of. Because again, this is not sustainable. Major financial lenders having monetary issues, plummeting 10% in pre-market and now being up 2.04% intraday is not sustainable. It's a bear market rally. And historically, and this again terrifies me to say, I believe 4 out of the top 10 updates for the NASDAQ have occurred in October, meaning historically, going back decades. I think 4 out of the top 10 intraday rallies that upwards of 7, 8, 10% have been in October. So October is not a uncommon month to see absurd gains in. They don't shock me, especially coming off of September, which is historically a horrible month for stocks. However, do not get ahead of yourself. These rallies are not sustainable. They don't change the underlying conditions that we find ourselves in domestically and globally. The economy, let me rephrase this. The employment market is still unsustainably hot. The housing market is horrendously weak. Production is poor. Manufacturing is poor. Inventory we've seen now at excess levels. In oil we've seen demand destruction. The economy is kind of mixed, but overall it's not positive. It will correct. Inevitably, it has to. Because unless we would like to see a horrible cataclysmic crashing and burning, it has to go down eventually. And those people listening like, wait, it has gone down already. It's at 25% down, year to date. No, man. 2008 financial crisis, if I remember correctly, was down 50%. Dot-com bubble crash from 2000 2002, NASDAQ lost 81% of its value. 25% ain't it? This is a good start. We are remarkably far away from being done. And the more news that breaks, again, watching Credit Suisse now jump to 2.17% up, despite having major financial issues. Things will happen. Things will correct. But again, to take a step back from the gloom and doom side of things. There will be, inevitably, once we've actually had a recession, there will be a boom, a bull market after it. The keyword there is still after it, though. We have to get the hard part out of the way. We have to stop letting the infection spread throughout the entire body. If it's in the arm, fine. Cut off the arm to save the rest of it. We're in too deep. Because at this point, if now we're trying to get to a point where every major global economy has to fiscally announce a recession, it's the point where none of us can help each other, so that there's no bailouts for anyone, and see how many companies go under. I hope it doesn't get to that, but if that's what needs to happen, fine. We'll see how it goes. And that is all that I have. Again, that might not be the most optimistic return to form for the podcast. However, again, history has a tendency to repeat itself, and we are smack dab in the middle of watching the same movie that we saw playing 14 years ago. And because of that, we know how it ends. So hopefully you can prepare yourself, or at minimum, get some popcorn ready. Thank you for joining me. Again, I will not be here Wednesday in observance of Yom Kippur. I will be back on Friday. I appreciate all of you for tuning in. I hope that you enjoy your week until I am back with you. Stay safe, have a good time, and I will talk to you all on Friday.